Welcome back to the channel. Today, we're uncovering a hidden truth about your investments, one that many people overlook until it's too late. We're talking about capital gains tax. It's not just a line item on your tax return, it's a silent wealth killer, relentlessly eroding your investment gains over time. You see, while you celebrate investment growth, a significant portion of that growth is often silently earmarked for the taxman. This video isn't about avoiding taxes, it's about understanding their profound impact and learning how to protect more of what you earn. Let's dive deep into how this tax truly affects your financial future. First, let's establish a clear definition. What exactly is capital gains tax? Simply put, it's a tax levied on the profit you make from selling an asset that has increased in value. Think of it this way: if you buy a stock for $100 and later sell it for $150, that $50 profit is your capital gain. The government then taxes a percentage of that profit. This applies to a wide range of assets, including stocks, bonds, real estate, and even collectibles. Understanding this basic concept is the first step to recognizing its true impact on your financial journey. Not all capital gains are taxed equally. The IRS distinguishes between short-term and long-term capital gains, and this distinction is crucial. Short-term capital gains are profits from assets held for 1 year or less. These are taxed at your ordinary income tax rates, which can be as high as 37%. Long-term capital gains, on the other hand, are profits from assets held for more than a year. These enjoy more favorable rates, 0%, 15%, or 20% at the federal level, depending on your taxable income. This difference is not just significant, it's foundational to smart tax planning. Beyond federal taxes, many states also impose their own capital gains taxes. These can range from 0% in states like Florida and Texas to a hefty 13.3% in California. This means the actual tax bite on your investment profits can be much higher than just the federal rate alone. Imagine the combined impact: a 20% federal long-term rate plus 13.3% state tax means over a third of your investment gains could vanish. This often overlooked layer significantly increases the total cost, further eroding your wealth if not accounted for in your financial strategy. And then there's another layer, the net investment income tax, or NIIT. This is an additional 3.8% tax on certain net investment income for individuals, estates, and trusts who meet specific income thresholds. For individuals, if your modified adjusted gross income exceeds $200,000, single filers, or $250,000, married filing jointly, you're likely subject to this tax. This means that your long-term capital gains tax could effectively be 23.8%, 20% federal plus 3.8% NIIT, before even considering state taxes. It's an extra, often surprising, deduction from your potential earnings. Before we delve into specific examples, we must introduce another silent wealth killer: inflation. Inflation is the rate at which the general level of prices for goods and services is rising, and consequently, the purchasing power of currency is falling. Historically, the average inflation rate has hovered around 3% annually. What does this mean for your investments? It means that even if your investment grows in nominal terms, its real purchasing power might be much lower. Capital gains tax is often levied on these nominal gains, further diminishing your true, inflation-adjusted returns. Now, let's illustrate the true impact with a concrete example. Imagine you invest $100,000. For simplicity, let's assume this investment grows at a consistent 7% annually over 20 years. This might sound like a solid, realistic return, right? Over 2 decades, without any tax considerations, this initial $100,000 would blossom into a substantial sum. But taxes, especially capital gains tax, don't wait until the end to take their cut. They chip away at the very foundation of your potential growth, year after year, or rather, gain after gain. Let's see just how significant this impact can be. In a perfect world, without any taxes, our $100,000 investment growing at 7% annually for 20 years would look like this. The magic of compounding would work wonders. allowing your earnings to generate further earnings, accelerating your wealth accumulation. After 2 decades, that initial $100,000 would grow to a remarkable $386,968. This is the theoretical maximum, the benchmark against which we measure the silent erosion caused by capital gains tax. It's a powerful illustration of compounding's potential when left undisturbed. Now, let's introduce the capital gains tax. Suppose at the end of 20 years, you decide to sell your investment, realizing a long-term capital gain. Let's assume you're in the 20% federal long-term capital gains tax bracket. Your total gain is $286,968, $386,968 to $100,000. A 20% tax on this gain amounts to $57,393.60. After paying this tax, your net proceeds would be $331,574. Compare this to the tax-free scenario. You've effectively lost $55,394 due to federal capital gains tax alone. That's a substantial reduction in your hard-earned wealth. But wait, there's more. If your income qualifies for the net investment income tax, that's an additional 3.8%. So, your total federal tax rate on long-term capital gains could be 23.8%. In our example, a 23.8% tax on the $286,968 gain would be $68,300. This brings your net proceeds down to $318,668. Now, the effective loss from the tax-free scenario climbs to $68,300. This layered taxation significantly reduces your investment's true power, demonstrating how these silent costs compound into a substantial drain on your wealth. Let's put these numbers side by side to truly see the impact. Your $100,000 investment over 20 years, without any taxes, it grows to $386,968. With a 20% federal capital gains tax, it's $331,574. And if you're subject to the 3.8% NIT, it drops further to $320,668. The difference between the ideal untaxed scenario and the combined tax burden is over $66,000. This isn't just lost income, it's lost compounding potential, money that could have continued to grow for you. This is the silent wealth killer in action, dramatically reducing your financial freedom. Why is this loss so significant? It's because taxes don't just take a slice of your initial gain, they take a slice of the money that would have compounded over time. Imagine you earn $100 in capital gains. If you pay $20 in tax, you only have $80 left to reinvest and continue growing. That $20, if left untaxed, could have generated more earnings, and those earnings would have generated even more. This growth on growth is the true power of compounding, and capital gains tax, by taking its cut, starves your compounding engine, diminishing your long-term wealth potential. Let's meet Sarah. Sarah is a patient, long-term investor. She invested $100,000 in a diversified portfolio 20 years ago, letting it grow without touching it. She understood the power of compounding. When she finally decided to sell and fund her retirement, her investment had grown substantially. She happily saw her portfolio value, but then the tax bill arrived. Even though she paid the lower long-term capital gains rate, she was surprised by how much of her hard-earned gains went to taxes, significantly reducing her actual retirement nest egg. She realized the tax wasn't just a number, but a substantial sum she couldn't use. Now consider Michael. Michael is a more active trader, often buying and selling assets within a year, seeking quick profits. 2 years ago, he invested $100,000. He saw some strong gains early on and decided to sell. Since he held his investments for less than a year, his gains were considered short-term and were taxed at his ordinary income rate, which was 32%. This meant a much larger percentage of his profits went to taxes compared to Sarah. Michael's experience highlights how frequently trading can significantly amplify your tax burden, making it even harder to build substantial wealth over time. Why do so many people underestimate capital gains tax? One major reason is present bias. We tend to prioritize immediate rewards and costs over future ones. When you see your investment portfolio grow, you focus on the nominal gain today, not the chunk that will be taken out upon sale, potentially years from now. The tax isn't deducted instantly from your account balance, making it an abstract future cost rather than a tangible present one. This psychological tendency makes us less likely to factor in the long-term erosion of our wealth. Another psychological factor at play is loss aversion. People tend to feel the pain of a loss more strongly than the pleasure of an equivalent gain. While capital gains tax isn't a loss in the traditional sense, it feels like one because it reduces your expected profit. However, because it's a tax on a gain, not an actual dip in your principal, it doesn't trigger the same alarm bells as a market downturn. This makes it easier to dismiss or underestimate, allowing it to silently chip away at your compounded returns without a strong emotional response to counteract it. So, how can you protect your money? The single most effective, yet simple, strategy against capital gains tax is to hold your investments for the long term. Remember the distinction: assets held for over a year qualify for significantly lower long-term capital gains rates. By simply being patient and avoiding frequent trading, you can cut your tax bill by a huge margin. This strategy not only benefits from lower tax rates but also maximizes the power of compounding, allowing your investments more time to grow undisturbed and creating greater wealth over time. This is the cornerstone of smart investing. Holding for the long term provides another powerful advantage: tax deferral. You only pay capital gains tax when you actually sell the asset and realize the gain. As long as you hold on to your investment, your gains continue to grow tax-free. This means the money that would have gone to taxes remains invested, continuing to earn returns and compound. The longer you defer, the more time your entire principal and all its accrued gains have to work for you, accumulating more wealth before the taxman eventually takes his share. Deferral is compounding's best friend. Beyond simply holding, utilizing tax-advantaged accounts is another critical strategy. These are special investment vehicles designed to give you tax breaks, either now or in the future. The government encourages saving for specific goals like retirement or education by offering these benefits. Understanding and utilizing these accounts can significantly reduce your tax burden on investment gains, allowing more of your money to work for you. Let's explore some of the most common and powerful options available to you, each with unique advantages for different financial goals. For retirement, the 401k and traditional IRA are excellent choices. Contributions to these accounts are often pre-tax, meaning they reduce your taxable income in the year you contribute. Your investments then grow tax-deferred until retirement. This means no capital gains tax year after year on your growth, only when you withdraw. You pay ordinary income tax on withdrawals in retirement, but often, you're in a lower tax bracket then. This deferral allows your investments to compound much more aggressively without the annual drag of taxes. The Roth IRA offers a different, yet equally powerful, tax advantage. Contributions to a Roth IRA are made with after-tax dollars, meaning they don't give you an immediate tax deduction. However, the magic happens on the back end: your investments grow tax-free, and qualified withdrawals in retirement are completely tax-free. This includes all your capital gains. If you anticipate being in a higher tax bracket in retirement than you are now, a Roth IRA can be an incredibly powerful tool to avoid future capital gains and income taxes on your investment growth. For education savings, 529 plans are highly effective. These plans allow your investments to grow tax-free, and withdrawals for qualified educational expenses, like tuition or housing, are also tax-free. Many states also offer a tax deduction or credit for contributions to their 529 plans. This is a powerful way to save for a child's college education without worrying about capital gains tax eating into your returns. It allows every dollar of growth to directly benefit educational goals, maximizing your savings potential. Often called the triple tax advantage account, health savings accounts, or HSAs, are an incredible tool for those with high deductible health plans. Contributions are tax-deductible, investments grow tax-free, and withdrawals for qualified medical expenses are tax-free. This means all your capital gains within an HSA completely bypass taxation. If you don't use the money for medical expenses, it can function like an additional retirement account after age 65, or withdrawals are taxed as ordinary income. It's one of the most tax-efficient savings vehicles available. Another powerful strategy is tax loss harvesting. This involves selling investments at a loss to offset capital gains and even a portion of ordinary income. For example, if you have realized $10,000 in capital gains from some profitable investments, you could sell another investment that has lost $10,000. This loss can then harvest or cancel out your gain, effectively reducing your taxable capital gains to zero for that year. If you have more losses than gains, you can even deduct up to $3,000 per year against ordinary income, carrying forward any excess losses to future years. Let's break down how tax loss harvesting practically works. Throughout the year, you might have some investments that performed well, leading to capital gains, and others that underperformed, resulting in capital losses. Before the end of the tax year, you intentionally sell those losing investments. The realized loss from these sales is then used to reduce your taxable capital gains. This proactive management of your portfolio allows you to minimize your tax liability without necessarily altering your long-term investment strategy. It's about being smart with your sales, not just your purchases. For those with significant wealth and a philanthropic spirit, gifting appreciated assets can be a very tax-efficient strategy. Instead of selling a stock with a large capital gain and then donating the cash, you can donate the stock directly to a qualified charity. When you do this, you generally avoid paying capital gains tax on the appreciation. Additionally, you can still claim a charitable deduction for the fair market value of the asset. This allows you to support causes you care about while simultaneously reducing your personal tax burden, a win-win scenario for you and the charity. Finally, for your heirs, step-up in basis through estate planning is a powerful, albeit often misunderstood, benefit. When you inherit an asset, its cost basis is stepped up to its market value on the date of the original owner's death. This means if you inherit a stock that your parent bought for $10 and is now worth $100, your new cost basis is $100. If you then sell it for $100, you realize no capital gain. This effectively eliminates all capital gains tax on the appreciation that occurred during the original owner's lifetime. It's a significant advantage for intergenerational wealth transfer. To elaborate, imagine a scenario where an investor bought shares worth $10,000 decades ago, and they're now valued at $200,000. If that investor sold them during their lifetime, they'd owe capital gains tax on the $190,000 profit. However, if those shares are passed on to an heir after the investor's death, the heir's basis for those shares automatically becomes $200,000. This means if the heir sells the shares immediately for $200,000, there's no taxable capital gain whatsoever. This rule significantly minimizes the tax burden on inherited appreciated assets, supporting wealth preservation across generations. Let's quickly recap the hidden costs. Capital gains tax is more than just a percentage, it's a silent wealth killer that, first, reduces your real investment returns due to inflation and the tax itself, second, starves your compounding engine, taking away money that would have otherwise grown exponentially, and third, it's underestimated due to psychological biases like present bias and loss aversion. The combination of federal rates, state rates, and the NIIT can make the total tax bite substantial, especially for short-term gains. Understanding these mechanisms is key to protecting your financial future. But as we've seen, you're not powerless against this silent killer. You have powerful strategies at your disposal. The most impactful is simply holding your investments for the long term to benefit from lower tax rates and continuous compounding. Beyond that, strategically use tax-advantaged accounts like 401(k), IRAs, Roth IRAs, 529s, and HSAs. Consider tax loss harvesting to offset gains, and explore gifting appreciated assets for charitable deductions. Finally, for long-term wealth transfer, understand the step-up in basis. Each of these tools helps you keep more of your hard-earned money. If there's one simple strategy you take away from today's deep dive, let it be this: hold your investments for the long term. This isn't just about patience, it's about intelligent tax planning. By simply extending your holding period beyond 1 year, you unlock significantly lower federal capital gains tax rates, potentially saving you tens of thousands of dollars over an investment's lifetime. More importantly, it allows the true magic of compounding to work uninterrupted, transforming modest investments into substantial wealth. It's the simplest, yet most profound way to protect your money from the silent wealth killer. Understanding the hidden cost of capital gains tax is a crucial step towards smarter financial planning and preserving your wealth. Don't let this silent killer erode your future. By implementing these strategies, especially the simple act of holding for the long term, you can keep more of what you earn and build a more secure financial future. If this deep dive helped you understand capital gains tax better, please give this video a thumbs up. Subscribe to the channel for more insights into managing your money wisely, and share your own tax saving strategies in the comments below. We love hearing from you.